The Social Security Administration does not apply identical rules to everybody. That is not an opinion. That is not a grievance. That is the actual policy embedded in the law. And it means that the rules governing your monthly payment, your full retirement age, your claiming options, and the errors that can permanently reduce your check are completely different depending on the year you were born. Not slightly different, meaningfully, significantly, sometimes devastatingly different. And right now, in 2026, there are people in every single one of the groups I am going to cover today who are either receiving less than they are legally entitled to, or who are standing right at the edge of making a decision they will not be able to reverse, simply because nobody has ever sat down and explained what the rules actually are for their specific birth year. Not for everyone in general, not for the typical American, for them, for their exact situation. That is what this video is going to accomplish. I am going to walk through 4 distinct groups based on birth year, and I need you to do one thing. Find your group and listen specifically to what applies to you. Because what I say about one group may not apply to yours at all. And what I say about your group may be the most financially important thing you hear this year. By the conclusion of this video, you will know exactly what to verify, exactly what questions to raise, and exactly what to do before a deadline passes or an error gets locked in permanently. Before we get into the groups, if you are not subscribed to this channel, I want you to do that right now and turn on the notification bell. Here is why that genuinely matters and why I keep requesting it. The rules around Social Security shift constantly. Claiming ages shift, earnings limits shift, Medicare premium calculations shift, overpayment policies shift. And when any of those things shift, the Social Security Administration does not send you a personal letter explaining what it means for your specific situation. They alter the policy, they update a page on their website that most people will never visit, and they expect you to already know. The burden of staying informed is entirely on you, and for most people, that is not a reasonable expectation given how complicated the system is. What I do on this channel is take those changes, break them down by what they actually mean in real dollars for your specific situation, and get that information to you before the deadlines have passed and before the errors are already made. Every group I am covering today has something specific happening in 2026 that affects them directly. The people who are subscribed here find out about these things in time to act on them. The ones who are not tend to find out after the wrong claiming decision, after the deadline, after the money is already gone. Hit subscribe, turn on the bell, and let us get into the groups. Group 1 is for everyone born between 1943 and 1954. If you fall in that range, you are somewhere between 72 and 83 years old today. You have been on Social Security for a while. Your full retirement age was 66, and at this point in your life, most people in this group have settled into the assumption that there is nothing left to verify, nothing left to optimize, that the decisions are behind them, and the monthly payment is just what it is. That assumption is costing some of you real money every single month, and I want to address that directly. The first thing everyone in this group needs to examine, and I mean every single person in this group who lost a spouse, is whether they are currently collecting the correct benefit. This sounds like a simple question, but the answer is not always obvious, and the financial stakes attached to it are enormous. A significant number of widows and widowers in this age range are collecting their own retirement benefit when they would receive more money by switching to their late spouse's record. and a significant number are doing the opposite, sitting on a spousal survivor benefit when their own record would pay them more. The survivor benefit for a widow or widower can be up to 100% of what the deceased spouse was receiving at the time of their death. In many households, particularly those where one spouse had significantly higher lifetime earnings, that number is substantially larger than what the surviving spouse receives on their own record. We are sometimes talking about a difference of $300, $400, $500 a month or more, every month for the rest of your life. The Social Security Administration is not going to contact you and volunteer this information. They are not going to compare your two options and inform you which one pays more. That is not how the system operates. You have to ask. You have to call SSA at 1-800-772-1213. Tell them you want both benefit figures pulled and compared directly, and then make a decision based on the actual numbers. If you lost a spouse and have never specifically had that conversation, there is a real chance you have been leaving money on the table for years. That is a call worth making this week. The second thing for this group involves Medicare, and specifically something called the IRMAA surcharge, which stands for Income-Related Monthly Adjustment Amount. Here is what that means in plain language. Medicare uses your income from 2 years ago to determine how much you pay for Part B coverage. If your income 2 years ago was above a certain threshold, Medicare charges you extra on top of the standard premium every single month. In 2026, those surcharges range from an extra $70 a month on the low end to nearly $500 a month at the top tier. That is not a small amount. That is potentially $6,000 a year in additional premiums that many people are paying without fully understanding why. Here is the part that catches people off guard. That 2-year look back means Medicare may still be charging you based on income from a year when something unusual occurred. A sale of property, a Roth conversion, an inheritance, a one-time distribution from a retirement account. Any of those events can push your income into a higher bracket for that year. And 2 years later, Medicare is still charging you the elevated premium, even though your income has since returned to normal. There is a formal process to appeal this, and most people in this situation do not realize it exists. The form is called SSA 44, and it was specifically designed for people whose income has dropped due to what the SSA calls a life-changing event. That includes retirement, the death of a spouse, divorce, loss of pension, and others. If you are currently paying more than the standard Part B premium, and you believe your current income is lower than what Medicare is using to calculate your charge, the SSA 44 appeal process exists for exactly your situation. You file it with documentation of your current income, and if approved, your premium adjusts. If you are paying more than $185 a month for Medicare Part B right now, and you have not asked why, that is your next step. Group 2 is for everyone born between 1955 and 1959. If you fall in that range, you are somewhere between 67 and 71 years old today. And I want to state this plainly. This is the most critical group in 2026. Not because the rules are the most complicated, although they are nuanced, but because the people in this group are right now, at this very moment, either in the process of making their claiming decision or have recently made it. And the stakes of getting that decision right or wrong are not temporary, they are permanent. Here is the piece of information that a surprising number of people in this group do not know. Your full retirement age is not 66. It is also not 67. It is a specific month and year that is different for every single birth year in this 5-year window. And if you do not know your exact number down to the month, you do not have the information you need to make a sound claiming decision. Let me provide you the full breakdown right now. If you were born in 1955, your full retirement age is 66 years and 2 months. Born in 1956, your full retirement age is 66 years and 4 months. Born in 1957, it is 66 years and 6 months. Born in 1958, it is 66 years and 8 months. And if you were born in 1959, your full retirement age is 66 years and 10 months. That is your number, not the generic answer. Your specific month and year. Write it down right now if you have not already. Why does this matter so much? And why does it matter so much right now in 2026? Because the penalty for claiming before your full retirement age is not a temporary reduction. It is permanent. Every month you claim early relative to your specific full retirement age, your benefit is reduced by a fraction of a percent, and that reduced amount becomes your baseline for the rest of your life. The SSA does not adjust it upward later. It does not recalculate once you reach a certain age. Whatever reduced amount you lock in when you claim, that is what you receive from that point forward. Put some real numbers on it. If you were born in 1957, your full retirement age is 66 and 6 months. If you claimed at 62, your benefit was reduced by approximately 25.8% permanently. On a monthly benefit of $2,000, that reduction is $516 every single month, not for a few years, every month for the rest of your life. Over 20 years of retirement, that arithmetic produces a cumulative difference of approximately $123,000 compared to waiting until your full retirement age. The SSA does not remind you of this before you claim. They process the application, confirm that you understand your benefit will be reduced, and the permanently reduced amount becomes your check. Now, for everyone in this group who has not yet claimed, what you need to understand is that the door also swings in the other direction. Every month you delay past your full retirement age, your benefit increases by 2/3 of 1%. That compounds to roughly 8% per year. Between your full retirement age and age 70, you can accumulate an additional 24 to 32% more per month for life, depending on your exact birth year. On a $2,000 benefit, that potential increase of 24 to 32% is worth somewhere between $480 and $640 more per month, every month, for life. That is a calculation worth sitting with before you file. And for those in this group who are currently employed while also collecting Social Security before full retirement age, there is a rule called the earnings test that you need to understand clearly because its effects can feel alarming if you do not know it is coming. In 2026, if you earn more than $23,400 in a year while collecting Social Security before full retirement age, the SSA withholds $1 for every $2 you earn above that limit. On the surface, that looks like your payment simply disappearing. The important thing to know is that the money is not gone forever. Once you reach your full retirement age, The SSA recalculates your benefit and credits back the months that were withheld, effectively increasing your ongoing monthly payment going forward. But if you do not know this rule exists, watching a portion of your payment disappear without explanation is genuinely disorienting and leads people to make panicked decisions they do not need to make. Group 3 is for everyone born between 1960 and 1965. If you fall in that range, you are somewhere between 61 and 66 years old today. For everyone in this group, the full retirement age is exactly 67. No months, no fractions, just 67. And right now, the single most important thing for people in this group is building a clear, honest understanding of what happens to your monthly payment if you decide to claim before you reach that age. Let me provide you the number that matters most. Claiming at 62 with a full retirement age of 67 reduces your monthly benefit by 30%. That is not a rough estimate. That is the exact figure, and it is permanent. On a monthly benefit of $2,000, that is $600 less every single month for the rest of your life. Over 20 years of retirement, that cumulative loss compared to waiting until 67 is $144,000. That is not a rounding error. That is not a technicality. That is a significant portion of your retirement income, and the decision to claim early is one that cannot be walked back once it is made. The Social Security Administration will process your early claim. They will ask you to confirm that you understand your benefit will be reduced. You will say yes, and the reduced amount becomes your permanent baseline. There is no grace period. There is no reconsideration window. Once that application is processed and you receive your first payment, that number is set. I am not saying that claiming early is always the wrong decision. There are situations, health considerations, financial necessity, specific household circumstances where claiming early makes sense. What I am saying is that the decision needs to be made with full awareness of what it costs. A lot of people in this group make the early claim because they reach 62. They become aware that the option exists, and they proceed without running the full lifetime calculation. That is the mistake I want to help you avoid. There is also a claiming option available to people in this group that almost nobody inquires about, and it is worth knowing exists. If you apply for Social Security after reaching your full retirement age of 67, you can request up to 6 months of retroactive payments. The SSA pays you a lump sum as if you had applied up to 6 months earlier than you actually did. On a monthly benefit of $2,000, 6 months of retroactive payments is a lump sum of up to $12,000 delivered with your first check. The trade-off is that your ongoing monthly benefit is slightly lower than it would have been if you had filed on your actual application date, since your effective start date moves back. But the option exists. It is legitimate. It is underused, and almost nobody in this group knows to request it. For the people in this group who are still 5 or 6 years away from making any claiming decision at all, the single most valuable thing you can do right now is open your Social Security statement and verify your earnings record year by year while you still have time to correct it for free. I will explain exactly what I mean by that when we get to Group 4, because it applies equally to both groups. Group 4 is for everyone born in 1966 or later. If you fall in that category, you are 60 years old or younger today. You are not close to claiming Social Security. Retirement in the context of Social Security benefits is probably not something you are actively planning around yet. And that is precisely why what I am about to share matters so much. Because the window to correct certain things without it costing you money is still wide open right now, and it will not stay open forever. Your full retirement age is 67. Claiming at 62 means a permanent 30% reduction to your monthly benefit. Waiting until 70 means accumulating up to 24% more than your full retirement age benefit permanently. Those numbers are fixed. Congress has set them, and they are not changing for your age group based on anything currently in law. So, on the structural side of Social Security, you already know your parameters. What is not set yet, what is still within your ability to affect significantly, is whether your earnings record is accurate. And this is where I want to spend the most time with Group 4, because the stakes are real and the timeline for doing something about it is finite in a way that most people do not think about until it is too late. The Social Security Administration has been recording your payroll data since the very first job you ever held. Every year, your employers submitted payroll reports to the IRS and the SSA that included your earnings. That data became your earnings record, and your earnings record is what the SSA will use to calculate your monthly benefit when you eventually claim. The higher your recorded lifetime earnings, the higher your benefit. The lower your recorded earnings, the lower your benefit. Here is the problem. Every step in that chain, your employer's payroll submission, the SSA's recording of that data, the updating of your individual record, was performed by human beings using systems and processes that were far less automated in the 1980s and 1990s than they are today. And every step in that chain was an opportunity for something to go wrong. An employer who submitted a slightly incorrect number, a year that got missed entirely, a period of self-employment that was not reported correctly, a job change where records were not properly transferred, a clerical error that nobody ever caught because nobody ever checked. Each of those errors, if they go uncorrected, reduces your monthly benefit when you eventually claim by approximately $100 per missed or incorrect year. That might not sound catastrophic in isolation, but if you work through the 1980s and 1990s and your record has even 2 or 3 incorrect years, you are looking at a monthly benefit that is $200 to $300 lower than it should be every month for the rest of your life. The fix is straightforward. Go to ssa.gov, create a My Social Security account if you do not already have one, open your Social Security statement, and go through the earnings listed for every single year you worked, comparing them against whatever records you have. W-2 forms, old tax returns, pay stubs that you still have filed somewhere, any documentation of what you actually earned in a given year. If the number on your SSA statement does not match your records, you file a request for correction of earnings record with the supporting documentation, and the SSA processes the correction and updates your record. The reason I am telling Group 4 about this now, years or even decades before you plan to claim, is that documentation becomes harder to locate the longer you wait. W-2 forms from the 1990s that are sitting in a filing cabinet right now may not still be in that filing cabinet in 15 years. Old tax returns that you can still retrieve from your accountant today may not be retrievable in 2035 or 2040. Former employers whose payroll records could confirm your earnings may no longer exist as businesses by the time you actually need them. The window to gather that documentation and correct those errors is open right now. It will not stay open indefinitely, and every year of your earnings record that you fix now is a year that translates into higher monthly income for the rest of your retirement permanently, at no cost to you today. So here is the full picture, organized by group, so you can take exactly what applies to your situation and leave the rest. If you were born between 1943 and 1954, the two things to verify right now are whether you are collecting the correct benefit record, particularly if you lost a spouse, and whether you are being overcharged on Medicare through an IRMAA surcharge based on income from a higher earning year that no longer reflects your current situation. The SSA 44 appeal form exists for exactly that second scenario, and a phone call to SSA at 1-800-772-1213 can surface the first. If you were born between 1955 and 1959, know your exact full retirement age down to the month, because it is different for every birth year in your window, and the permanent financial consequences of claiming before that date are larger than most people realize. If you are still employed while collecting before your full retirement age, understand how the earnings test operates so you are not blindsided by a reduction you did not know was coming. If you were born between 1960 and 1965, understand what a 30% permanent reduction in real dollar terms means for your specific benefit before you make any claiming decision at 62. And inquire about the retroactive lump sum option if you are already past 67 and have not filed yet, because most people in that situation do not realize it exists. If you were born in 1966 or later, go to ssa.gov today, open your Social Security statement, and verify your earnings record year by year while you still have the documentation to correct any errors, and while the fix is completely free. Every year you catch now is a year that pays you back for the rest of your retirement. Subscribe to this channel so you hear about the next change before it becomes a problem. And share this video with someone you know who falls into one of these groups, because the odds are good that someone you care about is carrying an error right now that they do not know how to fix, and this video gives them a starting point.